But let's move on to the next section. The next section deals with inventory. Again, if they don't have inventory, then you can ignore it. But Barry's did have inventory. And so let's look at how many inventory accounts did they have? Do you remember? 3. They had inventory for gasoline, they had inventory for groceries, they had inventory for parts. And each of those inventories, do you recall, we calculated the cost of goods sold using, different methods. We use specs for one, we use percentage of sales for another, we use specific identification for the other. And so we use these different methods because they related to that particular inventory. And because we had to do that, that took more time. And so whenever they've got inventory, we've got to allow for that time that is going to be required. So line number 13 asks how many inventory classifications do they have, and we're going to just put 3 next to there. Line number 14 says, is a monthly inventory taken? Now, why is that important? That's important because that will determine the method of costing that we use for inventory, correct? And so we've got to ask them, do you take monthly inventory? Now, I loved Barry's because we used all 3 methods. Inventory was only taken on the gasoline, right? It was not taken on the parts and groceries as a regular, at the end of the year they might have taken it, but they didn't take it each month. And so each time they don't take inventory, it means that we have to use an estimate. And whenever we have to use an estimate, 2 things happen. We have to be really comfortable with that estimate. And secondly, it means that eventually we're going to have to fix that estimate. Because the only thing we know about an estimate is what? That it's wrong. Okay? We know it's not exactly that number. It's a guess of what that number is, and we know it's off, so that means eventually we're going to have to adjust it. So there's a factor that we use. If monthly inventory is taken, we say thank you very much by keeping the fee lower. And so we're going to multiply 5 times the number of inventory classifications where monthly inventory is taken, and we're going to multiply 10 times those classifications where it is not taken, allowing for the correction and the other concerns that we have. So 2 of the inventory classifications, inventory was not taken, so that's 2 times 10. 1 inventory, it was taken, so that's 1 times 5. The total then is 25 units in that number, okay? Then it says, is a running inventory necessary? Now, running inventory is where you are every time when you sell something, you record the cost as a cost of goods sold. Now, we dealt with that in City Cycle Company. Every time we sold a Honda, we recorded the cost, right? We dealt with that with Barry's Gas and Groceries on the parts. Every time we recorded every time we sold a part, we also recorded the cost. You might recall when we look at the invoices, do you recall that code that we used? Remember we talked about the coding of invoices and how critical it is and so forth, and we used a code so the customers didn't see the cost, correct? And so then we just interpret that code. And when we recorded the sale of the part, we also recorded the cost at that time, correct? Using that code. Okay? Well, that's a running inventory. And that means that for every invoice that we write, there are 2 transactions. There's one to record the sale and a second to record the cost of that sale. Okay? This is where we're going to account for it. You'll notice it says add number 3 and 5 above, and number 3 is the cash sales tickets, and number 5 is the accounts receivable sales tickets, or the credit sales tickets. And so we add those 2 together. What's our total? 6. 3 and 5 should be 3 is 3 and 5 is 3, and so 6 is the answer, okay? And what we're doing is we're picking up that other part of the sales transaction, the cost. And finally, we have a buffer there. And it asks us, does the business have daily electronic inventory cost calculations? And what that means is, are they keeping track of the cost on the computer? Most businesses don't, because it requires so much time to keep the costs up to date. Even large grocery stores, you run that can of beans through the beeper there, the scanner. You run it through the scanner, and it puts the price and the description on the sales, the ticket, right? Okay. It has the ability to also calculate what the cost of that can of beans was, but they don't do it because it takes so much manpower to keep that up. They just don't. They choose not to do it. They keep track of the counts. They know how many cans of beans they sold so that they can replenish them, but they don't keep track of the cost. So the answer to that question is most often going to be no, I do not have inventory cost calculations. So what factor are we going to put in there when they say no? Yeah, 30, okay? So go ahead and write 30 in there, okay? Now that takes care of inventory. Again, if they don't have inventory, you can skip right over that section.